Guys, welcome back to the ETF show. First one, January 1st, we're filming this. Probably will be posted the next day or two, but 2026 kicked off with a banger. Just wraps 2025. And so I figured me and Thomas would come on. We'll talk a little bit about, maybe we can hit a little bit about 2025, how it wrapped up. Obviously, silver, gold, running, the stock market still doing pretty well. Bitcoin, not so much. But we'd love to kind of dive into our predictions and thoughts going into 2026 as well, especially focused on the ETF side of things and how the broader market is going to perform. So we have Thomas here, who's keeping track of all the stuff going on in the ETF world, specifically as well in the Bitcoin world. So be sure to give him a follow on his personal accounts if that is of interest to you. An investor should carefully consider a fund's investment objective, risks, charges, and expenses before investing. A fund's prospectus and summary prospectus contain this and other information about the Rex shares. To obtain a fund's prospectus and summary prospectus, visit the website at rexshares.com. A fund's prospectus and summary prospectus should be read carefully before investing. We're super excited to be working with Rex Shares, one of our longest running clients. But Thomas, dude, welcome, of course, to another show. It's good to have you.
Yeah, thanks, man.
Yeah,
good to see you, Kate.
Yeah, absolutely. So tell me a little bit about where your head is at going into 2026. Definitely think it's a good idea to sort of get our sets sighted and figure out what we're looking at going to the new year.
Yeah. Well, we were talking a little bit sort of off camera about big thoughts on what's the macro picture looking like for this coming year, ideas, kind of market takes, what are we thinking coming into this new year? And it's always good as well with like new year, fresh take, like how do we see it going forward? And I got my big, I guess, idea that I think the way this is going to play out, and it can lead to a bunch of different predictions, is I see this AI trend kind of, in one sense, accelerating, but more particularly actually affecting the real economy this year in a way that it only started to last year. So last year we had a little bump in GDP because you got all this spending in the AI infrastructure. But this year, I think we're going to see in 2026, this is the year where it starts to affect some of the other broader macro issues. Like, for example, I see inflation actually coming down this year. I think we're going to see CPI under 2% this year. And that's just because you're going to see AI proliferate into all of these kind of main street businesses. And what does it fundamentally do? It's just making everything like any kind of a lot of the white collar work essentially cheaper, easier to produce. It's bad for the labor market. Like it's bearish for people looking for jobs. But what it does do is it means, I used to need 5 analysts for this. I can do it with 2 analysts and the AI, or 1 analyst and an AI. So I think we're going to see massive downward cost pressure on a lot of this stuff, which is probably going to be very good for stocks. And that's probably, I would say my first sort of prediction that comes from this. So my first prediction is lower CPI, but my second prediction is I think stocks will do well this year, and it won't just be Mag 7 stocks, which are the AI producers, but will actually be, a value pass through to some of these companies that are just going, it's hitting their bottom line. It's going to mean lower costs and it's going to flow through, and it's going to be more profitable for them. And so I think we're going to see this dynamic where you see that as AI proliferates, you see lower costs, you see a deflationary effect, and then you're going to have this like Lollapalooza where it's like a combination of effects where the Fed is going to come in and go, we've got downward pressure on CPI and potentially even some upward pressure on unemployment, because it's the same idea, right? You just need less. You have less demand for labor. You don't need. Already some of the more obvious basic stuff that we're all already seeing is on like call centers and this sort of thing. You can just automate this stuff with AI, but all of this agentic software is coming. That's going to mean I don't need to have an analyst that's sitting there sitting there on these, monkeys on spreadsheets. Like, we got computers that could do that for us now. And I think that that's going to lead to essentially this deflationary effect, combined with the Fed going, well, we need to actually prop up inflation, because the Fed has this weird dynamic, right, where they don't fight inflation. They're just kind of like, we want a little bit of inflation.
That is so true.
So they're, when inflation is running hot, it's like, oh, they will kind of, pull back on things to try and keep it down. But when the opposite happens, they're going to start pumping money into the system. And we saw that after the global financial crisis, obviously, in the 2010s, right? There was the deflationary story for completely different reasons, but you had CPI and 1% in the economy. And then that was just a mandate to print. And that was very different, because then, and at that point in time, you had kind of people falling out of the workforce, but for different reasons. You had lower participation rates, and people that basically essentially dropped out of the economy, but not because like they just stopped looking for work. This was a huge effect that happened in the 2010s, and I suspect we might see more of that trend as well. The kind of the rise of the NEETs and this sort of thing, which is just a continuation of what we've already been seeing: the not employed, not educated, just these young people that don't necessarily have a lot of promise, hope for the future. I do think that with this AI story, it does create a lot of uncertainty for the world, and that manifests itself in a lot of different ways. And that's also why, and we're going to talk about this more, but I definitely see a rise in degeneracy across the board, and that's going to manifest itself in so many different ways. We had this like really interesting article that came up this week talking about this essentially the lack of patience in the economy, and how it's manifesting itself across generationally because of all of these big macroeconomic trends, and how people are reacting to decades of asset price inflation. And essentially, it's like a psychological impact that happens on young people and how they respond, and the rational ways in which people go, I don't necessarily have the opportunities of past generations, or maybe going forward, I don't project to have these. The path is less clear, right? In a world where the AI is coming for your job, it's like, I got to make money now, and I need to do it, and it manifests itself in all these different ways. So, look, that's kind of a long rant from me. But my big overarching prediction for 2026, I'm keen to hear what you think, but is this kind of AI impact and how that affects the real economy in all these different ways.
Yeah, I think you and I are pretty aligned on that. We're seeing a lot of the same stuff, probably because we kind of view the market a little bit the same. We're also, at heart Bitcoiners as well. And I spent a lot of time in the AI world. I was doing a lot of work with Near Protocol a couple years ago, and got to see kind of what they're focused on. The AI agents are huge. Like you were talking about, like, what is the point of having a team of quants when you can just code a thing a couple times, you get an autonomous agent rolling through, and those are going to keep iterating on themselves. And there's high incentive to make that good for a lot of different people. And then also there's a high incentive to market that so other people can use it for their own stuff, because that's a product in itself. And so I also see AI really taking over. And yeah, we'll talk about that article towards the end there. There's a bunch of good stuff, actually. But I do see, I generally think, with 2026, I have no idea about Bitcoin, because we just saw it close. The year was supposed to be green, close red. And so I know some people put a lot of weight on that and some people don't.
So
we'll see like how
I'm very optimistic on that, actually.
We'll see how that kind of plays in. Yeah, go ahead.
Yeah, I think like, I'm not worried at all about the this whole concept of 4-year cycle and stuff. That that calendar stuff is there's no rationale behind it, right? It's just like looking up to the stars and going, this is not a rational, logical way of thinking about the markets. But what is a logical way of thinking about the markets is going, if we have rising liquidity from lower CPI and an injection of money coming from the Fed, and you have a booming stock market, there's every reason to be very optimistic about Bitcoin. I think that, like, I don't know what, I'm curious to hear what you actually think coming into this year, but I think we'll see over 150 by the end of the year.
Yeah, I'm torn, dude, because we've had a lot of discussions in our trading spaces, and half the panel, well, a lot of the traders are pretty sure we're going to see some pain, or at the very least, just sideways frustrating action for a little while. And then a lot of them have sort of like the underlying speculative side of the traders is that it'll end up just working out where it fits very similar to how it's always gone in past cycles, where by around this time next year we should be circling back up and rising into those nicer prices. It's very possible. I saw Kalshi put out predictions saying that Kalshi traders think that 120, I believe, will be the top for Bitcoin. So I'm honestly really torn, because the speculative side of me looks at the rest of the market. It looks at the ETF heat map for the year-to-date performance of 2025 and says, with Trump saying we're going to keep this money printer on, with everyone saying this market's going to be great, we have midterms coming up, I can't see a world where it's not more of this type of behavior. A little bit of red here and there, but generally pretty green amongst a lot of the market. A lot of excitement, obviously. We've got like the main 7 stocks basically in charge of the stock market. But a lot of people are now aware of these things. And so I'm kind of curious to see if they start to pivot at all. But generally, I'm thinking they want asset prices to rise. Doesn't look like we're in any situation for the dollar to just be outperforming everybody kind of thing. That does not seem to be the move. It seems like people in assets are going to be doing really well. We also saw silver go on an absolute tear. And so a lot of people are saying, hey, maybe this is why the money that was supposed to rotate back into the markets for the crypto side of things got taken over by a bit of some capital rotation going into silver, like we saw here. Silver versus NVIDIA was on my bingo card. With the top silver ETFs ranked by AUM, with iShares being shared literally every single day, SLV with 37.83 billion, all sorts of different silver miners and different various ETFs. But yeah, I mean, look at this. I mean, this is just crazy. We have gold followed by NVIDIA and then silver. Just absolutely crazy behavior, dude, in this market. So yeah, I guess in my head, like the internal belief in me says there's no possible way the halving cycles really be doing this, for Bitcoin. But at the same time, like that, dude, when Bitcoin topped out in October or whatever it was, and it's been kind of painful price action ever since. Like I could definitely see a situation where we go sideways for a while. But for the broader market, it looks like it's going to be up only and continuing to rise just as a slow rising fashion, because it seems like that's how it's set up to be,
Yeah, look, I mean, it's a funny coincidence, but to me, I think it is a coincidence. And I think the easiest way to look at it is NVIDIA topped out in October 2025. Like, it's a pretty fair stretch to go, oh yeah, because of Bitcoin's halving cycle, this caused the NVIDIA top. Like that's such a stretch of logic that I'm just like, it defies all rationale. I do think, it's actually been really funny to see silver get this, because I admit, like, crypto it's just been a terrible run, right? I mean, honestly, it's so funny. Crypto didn't have an alt season, but precious metals had an alt season. Like gold has run, and then suddenly the precious metal alts like silver has done so well. But I do think that we're going to get a lesson in. I mean, like, hilariously, this is the classic story. This is like the underlying idea in the Bitcoin standard, or the like Plan B's original stock to flow model, right? Which is basically this very basic idea that you can't increase the supply of Bitcoin in response to price, but you can do that for some of these precious metals. So all of these, like silver, for example, right? There's so much silver underground, and all of these projects have just been unlocked because the price of silver has gone up. And so you're going to see a situation.
Yeah, I was going to say, like, right before silver took off, that's what people were worried about with gold. They're like, if we find a new pocket of gold the gold miners are going to go crazy. We're going to see 10 times as much operations and money being thrown at trying to find more gold. And that's kind of what we're seeing with silver, like a lot of attention moving into like the silver, like the proxy plays, I guess you could call it, instead of just buying spot silver. And obviously, if you're buying spot silver, you take a bit of a hit when you go because of the premium. Like the people who are buying the silver are like, I'm not going to pay full price. Like, you're here to give me this hunk of change. Like, I'm gonna pay 70% of it or whatever. And so a lot of people have jumped into the various ETFs and the various miners and stuff because you can sell a little bit faster. You can just do it on your phone.
But I will say that it is an amazing use case for the ETFs, like silver, for example. Like, I mean, particularly compare that to, first of all, gold would be annoying in its own right, but silver, if you wanted to take an actual position in silver, think about, like, you have to get this gigantic fucking safe into your house in order to hold these physical bars if you wanted to actually take a significant position in hard silver. Like, it's a terrible, it's the most inconvenient, terrible. I mean, yeah, that's true of gold, but at least like the price of gold relative to the weight of gold is quite high. But silver, it's not even the case. So you have to be like, you have to have so much space. It's the least practical. I mean, it's the absolute least practical way of investing in something with physical silver. At least, these ETFs make it, a practical and easy method for doing that. And so that's why you are seeing all these massive inflows into them. But I guess here's another.
We have the Bitwise ETFs. Yeah. This is very recent, but Bitwise, who's big time crypto leader, especially for various crypto products, ETPs, ETFs, they came out with 11 new ETFs. We've got an I'll just read out the tickers for them. Aave, we have CC, ENA, Hyperliquid, NEAR, STRK, SWI, Tau, TRX, Uni, and Zcash. A lot of these I recognize from a lot of our trading spaces, but these were just filed. And so it looks like even in the crypto world, the ETF side of things is still launching. There's still various ETFs coming out. And I will say this, like, besides the traders, everyone else is basically gearing up as if the crypto market is going to be tracking along with the stock market, just continuing to rise as a slow grind because they keep putting them out. Or, the other side of it is they're thinking that we've kind of hit the end of the road and they're just trying to fit everything in towards the end while there's still funding and interest for the next year. And so that's kind of why I'm torn, is because I can understand both arguments. And so far, it's tough to go with the speculative we're going to keep rising because the crypto prices are just continuing to crash. And we've got these digital asset treasury companies coming out, and they're like, we're just going to keep buying. And I'm like, but if the price goes down, you're going to keep buying? They're like, well, of course. I'm like, that's probably good, and that's probably the right answer, unless it just keeps dying. And so I think that's like the dichotomy I'm wrestling with especially with a lot of these cryptos, like the smaller ones,
Yeah, well, I mean, what I would say is that a company like Bitwise, they don't really care what happens to the price of these things. I mean, the only thing they benefit from is, rising assets under management in this situation. So yes, it's good if the price rises because the dollar value of their ETF rises. And bear in mind that that's how they make money, right? They take a percentage, and probably not a large percentage. They typically with these things it'll be less than half, 0.5% annually. So it's not a big clip. But when you look at this stuff, you go, their concern is the demand there, and they obviously believe that the demand will be there. Otherwise, they wouldn't do it because it costs money for them to set up these ETFs too, right? So it's not a profitable act. Like, if they set up an Aave ETF and it gets no funds, no assets under management, they're just going to be losing money as a business for Bitwise. So they obviously believe that there is some demand for these ETFs. But on the other hand, they just need the demand. They don't really care about this, like the price. The price can go sideways for all they care. As long as they get the people buying their ETF, they're golden. So I don't necessarily take it as bullish or bearish when I see these kind of ETFs setting up. It's more like people see an opportunity in the market, for this kind of stuff. And good luck to them. They might make some money doing it, but it's neither here nor there. And I do think that for me, I mean, we've said before in the crypto space, like I'm very much a believer that Bitcoin is the cryptocurrency that you want to, like, that's a long-term thesis. Some of these other ones, great, good luck to you if you're a trader, but you can't, like, if your strategy is like, I'm going to buy the near ETF and hold it for years, like, you're going to get wrecked, like, guaranteed you're going to get wrecked. I mean, that's my opinion, but like, that's just like financial suicide, in my opinion. You want to hold it for a week because you've got to bet on, like, you think Trump's about to tweet something bullish or whatever, fine, go for it. But you can't hold these things for a long period of time. You're guaranteed to, at the very least, underperform Bitcoin. Like, as a crypto market, if the whole crypto market goes up, maybe you make some dollars, but you're going to underperform Bitcoin. And obviously, if Bitcoin does poorly and you're holding these kind of higher beta, higher risk, lesser known crypto coins, then you're definitely going to underperform Bitcoin as well. So to me, it's a losing strategy as a long-term play.
Yeah, no, I honestly not going to find a ton of arguments for me. One thing I was kind of looking at here while you were speaking was you had mentioned, just to sort of what's the word I'm looking for, like foreshadow to the big article that you had sent me that I thought was really interesting. I was kind of curious on like which ETF areas and sectors would perform the best. Like, obviously emerging markets are always going to do well, but also one thing I had thought about, I was speaking with someone at dinner like a day or two ago, and they just kept talking about dividends. I remember, and I remember just always thinking, like, the dividends are so interesting because you generally need to hold a good amount of that stock to get any kind of worthwhile dividend. You got to chunk over a good amount of change and be hopeful that it's going to continue to do well, so that it sort of pays off and is also paying you out monthly or quarterly money. But that article you're mentioning of people are tired of waiting. They want the stuff now. They want the fast stuff now. They don't want to wait till they're 70 to make money. They want to be 45 and balling out, 30, even better kind of thing. And so people are generally looking for that edge in the market. It's like, obviously emerging markets have always done well. It's so interesting to see the commodities running with the recent price action here. And I imagine we'll start to see the world change a little bit as the conversation gets bigger, as the online finance world on X keeps continuing to expand, and people are realizing a lot of their older investments maybe aren't doing as well, the stuff people used to buy 10, 20 years ago. And like one thing we had here that I thought was interesting that you sent me as well from Leverage Shares, shout outs, but December launching 17 new 2X long ETFs. So you can say what you want, whether or not you agree or you think that's good or not. But there's demand here, obviously. People want the double X leveraged ETFs, especially if they're a trader. If you're a good trader, you're a competent trader, then yeah, no problem. You hop in these things, like Thomas said, probably not for 5 years, but perhaps at 5 something else, and you're able to trade the thing and write it up and down. But it definitely got me thinking of like what sectors of the ETF world are going to pop and where people are going to focus a lot of their attention. So I didn't know if there's anything on like the heat map that kind of stuck out to you, or just kind of like we were talking about with the double X long ETFs before we kind of dive into that article as well.
Yeah, well, look, I do think, look, I mean, one ETF, just getting back to Bitcoin, I think the IBIT ETF, which is BlackRock's long Bitcoin ETF, is going to do very well this year. And I see that because I think, Bitcoin fundamentally will do well. And I also think it's really interesting watching just the actual dynamics of within the Bitcoin market, how much IBIT is growing as its assets under management. It's extraordinary. It grew 220,000 Bitcoin last year in a world where, Bitcoin price went down during that period. So it's rather, yeah. So you can see iShares have got 770,000 Bitcoin held, right? That is, it started with 550,000 last year. And in a world where Bitcoin price is going down, IBIT's just chewing up all these Bitcoin. And the thing we see consistently is when the pump comes, that's when the flows really come hard for BlackRock. So I do see, I think BlackRock will hold over 1 million coins by the end of this year, and I do think that that's going to be I think it's going to do well this year. I think the big. I mean, I would counter sort of this 4-year narrative, and I do think it's going to do well. But I mean, it's not the only one. I think that a lot of the getting back to the broader stock market, I see just QQQ, the our Nasdaq software stocks doing quite well. It typically does outperform in these kind of bullish environments, and I kind of see S&P 500 probably doing 15-20% this year, and I could see Nasdaq doing 25 in an environment where you have lower CPI and you have lower Fed funds rate. Yeah, I think QQQ will do very well. And then getting to some of the levered ETFs, you probably will there'll be opportunities to do extremely well. I mean, if we think back to a time not too long ago when you had this sort of COVID period where you did have a really, really intense risk on environment, that's when you saw some of these kind of these sort of higher beta tech companies really, really do well, these software companies. And I can kind of imagine an environment in a world where you have, again, in this sort of deflationary world, it just tends to hit the high beta stocks doing really well. Like Kathy's fund, ARC's ETFs, which over any 5-year period have not done very well. But you can pick out select periods where in the kind of a risk on environment, they do fantastically well. And I think that we might be heading towards this kind of I don't want to say blow off top, but I still think there's more juice to squeeze in this bull market. And I think it's like, if you want to compare it to when you had the internet bubble of the late 90s, right? This wasn't like a 1-year phenomenon, right? You had stocks do extremely well in 96, 97, 98, 90. Yes, eventually things got too frothy, but I don't see us as in this kind of like late 99, everything is about to burst situation. In fact, honestly, I see some pretty good value in some of these AI stocks as well. So just to pick like one as an example, but we're seeing deals with Google are making with some of these data center companies. Like these are like pristine bond-like investments being made, in the sense of, say, Hut 8 is getting a deal where they're going to be making hundreds of millions of dollars of profit every year for these, just providing energy to Google, essentially for this AI, and it's hundreds of millions of dollars of profit every year. Google are backstopping it. These $3 trillion behemoth behind it, backing it. It's as good as credit can be, and these companies like this, and there's probably going to be more deals coming for these AI stocks. I just think they're going to do really well, and I just think it's going to fly in the face of a lot of people set up for kind of a bearish position coming into the year. And to your point about how you're in these kind of trading groups and a lot of people are bearish, and a lot of well, that's usually the setup for a bull run, right? Like when you look at the situations where everybody is extremely bullish, that tends to be when things don't go so well. But the market tends to have to climb this wall of worry in order to have these sort of sustained bull runs. And I kind of think that's where we are at.
Yeah, we'll definitely see. I think, they're not, it's not so much that the traders are like, we're headed down forever. They're just looking at it and they're like, look, every time we get some energy up, it just gets eaten up by the bigger redder candles, which I also see.
Sure.
I mean, it's frustrating, I think, for a lot of people, especially those, like, I know Grant Cardone got into Bitcoin, was excited about it. It starts to crumble down. The one thing that's interesting though is like just about everyone in the market, whether or not they're a crypto maxi or stock maxi or whatever, a lot of them are hedged with something else in the market. Like a lot of the Bitcoiners out there, they'll talk about it, but they're hedged 40% of their entire income or net worth is like in QQQ or whatever it is. And they're also in the stock market because that makes sense. And so generally people are, keeping track with the whole market. A lot of them are also gold bugs. They hold physical gold. A lot of them are also in the ETFs, even though they say they're not, just because it makes sense.
Yeah.
One thing to speak about what you believe on, versus also just being like, look, it's still a market. Like whether or not you think Bitcoin is the greatest thing ever to humanity or not, it's still an asset to be traded on the open market as well, and that's going to go through its ups and downs. One thing I have seen, which fully agree with you on this, and I'm glad you brought this one up, was this article, which by the way went mega viral. This is why you sent it to me. You're like, first off, it's an interesting read, but also it got 15 million views. So obviously there's some shred of truth to this. As people are in these markets, we saw October 10th for the crypto world. I know we're talking a lot about crypto, but you and I both kind of found our footing in the crypto world. We saw a lot of people get liquidated and crushed on October 10th. A lot of people left. But also even before that, in the markets, a lot of people are looking to find an edge, and a lot of them kept getting burned. And so people are generally, if you're getting extra active in these markets, you're not just someone who buys, the top 3 ETFs kind of thing and kind of just continue on with your life, then you're generally trying to find an edge. It's been hard for a lot of people out there who are maybe trying to get too into the weeds kind of thing. And there are all these various ETFs that are being offered so many options to get an edge and to win that sometimes people pull too many without doing their own research. And it led to this interesting world, which I'll kind of let you introduce this one. I thought it was fascinating, the prison of financial mediocrity, of just constantly comparing yourself. So I'll kind of let you introduce this one. I thought this was really interesting.
Yeah, so I think this article did so well because it just the idea resonated. Like most people kind of got it immediately, but the fundamental idea is that there are forces that are shaping essentially people's patience or willingness to trust that the future will be bright for them. And this could be this is typically essentially it's a rational reaction to the fact that when you look at the situation, be it AI putting a threat on people's jobs, or just the massive asset price inflation that we've seen over the years, where and he has this line where he essentially says, the boomers, intentionally or not, have kind of pulled up the ladder behind them. But essentially we have a situation where people don't feel confident, like, hey, if I just get a job and work hard for 25 years, like I'm going to make it, right? But then now, and that was the implicit social contract deal that existed in the previous generation. You had this idea that you were going to make it if you just worked hard. You join the law firm, you will become partner. You will get the house, you will get the family, you will get all these things if you are willing to work hard for it. But then what's happened now, as people in the sort of millennials and certainly Gen Z have less trust in the system, like that this is actually going to work out for them. So that there's a feeling that you don't have time to wait the decades to try and make it, because you might not get there anyway. Like you'll lose your job. You won't actually rise up the economic ladder. And so what that does is it creates these pressures to make it and make it now. And with that begets degeneracy, where it gets a gambling mentality. And what this article talks about is how it's not irrational. People know they're gambling, but they do it because this is their shot to make it. Like, you would say, well, you're probably going to lose, but people are like, yeah, I know, but this is still my best shot. What the article talks about is this kind of revealed preferences where, and he essentially argues that it's not the case that people are doing something stupid. It's that people they know exactly what they're doing. Like people will be, and this is how you get these kind of NFT crazes, or all these sorts of things where you see these bubbles forming and people jump in going, I know it's a bubble. I'm buying because it's a bubble. Like they're trying to make it. So it's a long degeneracy thesis. And then he talks about what that means in practice in terms of like, how would you invest if you wanted to, which I think is quite interesting as well. Is essentially saying, well, hey, the house always wins. So you want to be holding the kind of crypto infrastructure. He's talking about like a Coinbase, or for sports gambling. He has like the certain there are, you know, the FanDuel or whatever it is that for sports betting, and he lists a series of ways you can actually quote unquote play it if you want to be like, hey, you know, degeneracy's rising, so buy the house, which I think is interesting and kind of and I think the criticism of the article, which is valid, is that he kind of moralizes a lot in the earlier part of it, but then it's like, you know, it's sort of like, yeah, everybody's going to prison, so you want to buy the prisons kind of thing, which I think is pretty hilarious. But regardless of that, I think the reason why it got such an incredible amount of traction is that people can viscerally feel the sense that, yeah, the opportunities that existed for the millennial generation, for Gen Z, it's not what was the case for the boomers, right? You know, and you see it particularly in housing prices, right, where it's not just that housing prices are up, but they're so dramatically up relative to incomes. It's a completely different dynamic than what it was 20, 30 years ago. And everything stems psychologically from that in a certain types of way. If you don't have housing security, you don't have you don't necessarily have the kind of security to build a family and this sort of thing. But he also talks about in the article how we have this kind of perverse setup where on the, like, everything about that, you know, the asset inflation is true, but also equally the world has gotten better in a lot of different ways, and our basic needs are met. We're not hungry. We're not, you know, these kind of like problems that civilization had hundreds of years ago. It's just not there. Like your basic survival needs are met. Maslow's hierarchy of needs. He talks about this in the article, and that once you've sort of got, all right, I'm kind of functionally okay regardless of my wealth, but also I'm not going to make it regardless. So it's like, you know, basically the idea is you've got these millennials sitting with like $100,000, and they're like, hey, $100,000 is $10,000 to me. You know, it doesn't mean anything whether we go from 100. I got to get to 1 million, or this is worthless. Because I'm, you know, my basic needs will be met either way, but also I'm not rich enough to make it. So YOLO, essentially. That's the theme of the article. It's very interesting.
Yeah, I will say, I think it was a couple weeks ago we did our last episode, and we ended the conversation. You had asked a question, like, I think the question was something along the lines of, it was like what do you think of like our state of the economy, something like that. It was very similar to kind of this idea in the article of like, it might have been prediction markets related. Like, do I think they're going to continue growing? So it was something along those lines, somewhere in that department of conversation. And I remember saying, like, I don't know if I like it or not, but it's going to come either way. And I think that's maybe why he was sort of posturing a little bit in the article. But he's like, listen, like, this just is how it is. It's probably going to continue to be this way and continue to go because of the amount that there's the internet. I mean, this like extrapolates like a broader conversation of social media, people comparing themselves, seeing why their life isn't as good as the other next guy, as my neighbor, as this person with the car, whatever it is, when half of them are rented, half of them are just putting on. And so my thought was that, okay, so if generally, and like this was an interesting one to pull up here, I'll see if I can share this. Like this tweet here I saw from ETF Tracker was NASDAQ QQQ just closed the year up more than 20% for the third year in a row. SPY up over 10%. We had Dow Jones up more than 10%. And so in my head, I'm like, okay, so like all these, I mean, everyone here, I mean, you look at here as well, the top 100 ETFs, like a lot of them doing pretty well, 10 to 20%, a lot of them. And so in my head, I'm like, okay, so if we're in peak degeneracy, so like gambling mode is also on, peak like despair, maybe is the right way to put it, but sort of like okay, whatever despair, like, hey, I guess my life isn't that terrible, but at the same time everything sucks kind of mentality, which we're definitely seeing across the board. my only conclusion from that is like, well, it probably makes sense. Unfortunately, kind of like how he's saying, is to probably just invest in the market anyway. Even though, like, in some ways it's like, oh, we have to be at a top here. None of the numbers are making sense. The government's not, they're withholding information from the public. They're too scared to release these numbers because they're not good. Trump is online every day saying the economy is perfectly fine, nothing's wrong. Your taxes are going right where they should be going, all these sorts of things. And but they're not. But then at the same time, you can't just ignore the 20% every year. And so my head is like, okay, so like I generally, if you're like a smart investor, you're probably stacking the core assets, gold, Bitcoin, silver, like the hard assets that can survive sort of parallel to sort of like perpendicular / parallel, like they're on opposite tracks to the dollar. And so you need to hold some of those, which people like Ray Dalio have talked about. You should have a portion of your money in a hard asset, an anti-money, like a gold or a Bitcoin or a silver kind of thing. But then you should probably also be in the market a little bit. And so for those who are like, I can't figure out if it's going to be the next NVIDIA or if this one's going to be a rug, then a lot of them end up just picking these ETFs, right? I mean, it's hard to argue. I mean, you got the Q closing up 20%. I mean, you could have just put all your money in there and forgotten about it, walked away, and you'd be up 20%.
Yeah, well, I mean, look, I would say that's if people are responding that way, then it's a very in a way that's kind of the optimistic view of probably the intelligent investing case, where you are actually hopeful about the economy, you are actually hopeful about the market, and you actually are optimistic about the future. Where I think this article was suggesting was, you have that, but this is like a long-term investment thesis when it comes to investing in the market. But then you have all of these other dynamics going on simultaneously, where there's a whole segment of the population that are going like, how do I double my money in the next month? How do I double my money in the next 6 months? You have this gambling phenomenon that's taking place. And this also explains why, in part, why there's so much demand, as we talked about earlier, about all these the leverage ETFs, because people want the leverage ETFs, because that's where you can get, you can certainly blow up your portfolio, but you can also do really well in them, and if you catch a trend and you're right, which I think is, I guess the quote unquote long degeneracy theme of the article.
Well, hopefully people, that's a great point. Hopefully people are like in my head, I'm like, okay, because I agree with you. Like, and probably a portion of your portfolio should be in higher risk things like that, like a 2x long or whatever, asset investment thing that you could be, because a lot of people will have outperformance in some of those. Obviously you'll eat it sometimes and totally take the L, but that's also like why you have a portion of your investment there. But probably like for a lot of the smarter investors, regardless of like how the market felt or was, like whether we're peak degeneracy or not, a lot of like the top investors who are winning, at least, because that's, I mean, for me, I'm not going to try and create a whole new strategy. Like when I was starting to invest, I was like, okay, who's winning? I'm probably going to just roll with what they're doing, at least until I get deeper into the game. And maybe there's a different way, but generally, like, they got 80% of their money in strong, solid stuff that have shown performance, that have shown success and performance over the last decade or more, kind of thing. And so Bitcoin's a little bit higher risk. I'm not sure exactly how I ended up investing so much into Bitcoin, but that's how I ended up. But like if you're looking at that and you're like, okay, maybe in my head I was thinking Bitcoin's the safest of all the cryptos, so I'll put a large portion in there. But in my head I'm like, yeah, like even if you're pessimistic about the future, you still have to be relatively rational and be like, okay, I still need to put probably a good, strong, big portion into the main few ETFs. Maybe you're good enough to pick an NVIDIA and maybe you just are like super long Tesla and you're like, screw it, that's going to be 80% of my portfolio. But why not just go 75% into the main stock world and the bigger ETFs and maybe the Bitcoin and basic Bitcoin ETF, and then 10-20% goes into the leverage shares, 2x long Tesla or 4x long whatever, or BMNR or something that's like specifically there for a trade kind of thing. And in my head I'm like, that's probably the solution to this like mindset of I'm always behind, is you've got most of your money in the things that are generally trending up 10-20%. And then you've got other things in your market that give you a good day or a bad day, and you sort of keep yourself sane. I mean, that's the only real antidote that I can figure out from this, because I think you're right. I think there's a lot of people in just sort of like a Debbie Downer mode of just like, I can't catch a break.
Yeah, well, I do agree that you want to, look, I think that largely you want to be investing in the stuff. I mean, that is, you want a diversified portfolio of assets that are going to go up over time, actually. Like, as in, unless you have a very specific idea, but most people, most of the time, don't have the ideas. You know, it's this funny thing. There's like a meme that goes around that it's like, when it comes to building businesses, it's like, you know, ideas are a dime a dozen, execution is everything. And there's some truth to that when it comes to startup businesses. But when it comes to investing, actually, you know, ideas are really hard to come by, right? Like good ideas. It's really easy to have a lot of crappy ideas, but the really good ideas are very hard to come by. And most of the time, most people don't have that idea, which is fine. Because and if you don't have a very specific thesis, then that's when you want to be investing in this kind of a diversified portfolio that is going to, should broadly win under most market conditions. And that's why you have, you know, when you look at this, like VU, say, which is the Vanguard index for the S&P 500, you know, it's a diversified portfolio. Even if some of the sectors don't do well, there'll be some of the sectors that do well, and you end up getting 20% on the year, right? So, and it's not going to happen every year, but it's certainly, that's how it played out last year. And typically, when you look at these long run performances of the stock market, it's done extremely well. You know, and it can be timing dependent, of course, because there are certain periods of time when the stocks have done well and certain periods where it didn't. If you started investing in 2000, I think 3 of the first 8 years you had terrible stock markets. So you can get stuck based on your timing. But if you look at the last decade plus, it's just been an extraordinary bull market for stocks. And the question is, how long can this last? Which is a tricky one. But I don't think, you know, this is why it gets back to the old adage, like, it's time in the market, not timing the market, you know, for most of the time, because it's very hard for anybody to kind of, you know, when does the downturn happen? When does the reversal happen? Unless you're like, you know, the Fed chairman, and you can actually directly, you know, have your finger on the pulse and determine it. You don't know. You have to kind of play the market and just kind of time in the market to really do well. I think that's the only viable strategy.
Yeah, honestly, you might be right. I think generally, yeah, I agree with you. And hopefully, my goal is, you know, especially with all the shows we do on ETF Tracker, on Wolf, and a lot of the content that you put out as well, that people just, the main thing you got to do is just like really look at yourself in the mirror and figure out what kind of person you're going to be. In terms, like, for me, it was more about like, can a larger portion of the money that I have to my name be invested into my future? And like that peak degeneracy model you put up there, hopefully people take that, read it. If they see some of that in themselves as well, really look at their life and think, okay, like, is my money in the right things right now? Can I zoom out and like sort of pull myself out of the gunk of like just kind of throwing my money at nonsense and like praying that my poly market freaking Jake Paul fight, 7x100, whatever, isn't going to pan out. And like, hopefully they're able to sort of be like, okay, is a larger portion of my money to my name invested in anything? And if it is invested in anything, is that really an investment, or is this more of a gamble? Because it can build, and the truth is it can continue to compound, but you do have to make sure you have a job. You need to have income. You need to figure out a way to triple your income, quadruple it as many times as you can, and then put that into your future. And especially for financial, that means investing. It could be your business, like you were saying. It could be into the regular, or it could be into the financial structural plays, like the Coinbase, the place where crypto is going to live kind of thing for a lot of stuff. It could be whatever it is going to be. And there are so many options. Like we showed you guys the heat map a second ago. There's like 1,000 different areas of the market you can choose to throw your money into. You can be like a lot of people, just throw it into the VOO or whatever it is, and sort of just take a small piece of everything and generally just invest in the United States and be like, yeah, we're probably going to do well. Whether or not I think it's real or not. A lot of questions are now up in the air with the last administration, all the information that keeps coming out and will continue to come out, by the way. I think one thing that has probably been open, like Pandora's box for me now, is like the information era really truly is here. Like we are in a place where there will only be more information leaked. There will only be new information found. There will be old CIA, FBI, or like crazy murder file things. It'll just continue to be released over time. The people who were involved are not as involved anymore. Half of them are dead. And I'm just like, we're going to be in a world where all this is starting to become more out there. And then it's just about more like, are you an investor? Can you just be someone who looks at all that stuff, doesn't get too emotional, and says, okay, what do I believe in? Do I believe in hard money? Do I need to just get into gold, silver, and my diversification is the silver miners, the gold miners? Am I just a bit more kind of, separated from it? Do I just get 10% into everything? But more so for me, it's always just been about, can you be in an investing mindset? I think if you take it to that, you'll probably be fine. And every single hit will just be a punch to the face, and you continue to stand up like Rocky and you move on with your life. That's kind of my takeaway. So maybe I'm just like an eternal optimist, but that was generally like the feel I got from that article. It was like, I'm like, no, like it can't end like this. No, like I will not let this happen. So that's kind of how I took it. So I'll throw it back over to you for any comments on that or anything you kind of popped in your head while I was speaking on that. But otherwise, like this has been a pretty cool conversation. I definitely think this is it's gonna be a wild 2026 is what I'll say. We all thought that I think last year, but now with all this stuff coming out, everyone's kind of like, they look at 2026, we're just like, all right, let's begin,
Oh man, I love that. Look, I think you have to also, it comes back to this old know thyself. If you're someone that has the temptation to make these kind of degen plays, you probably, you might not the best, and even if you think this isn't necessarily in my long run interest, you might be someone that's better off allowing yourself to have like a fraction of your portfolio that you can kind of play with, and then having the bulk of it in kind of a safe, more diversified investments. Because if you don't allow yourself to do a little bit of degeneracy, then you might actually screw the whole pie. And that's not true for everybody, but as I said, it just comes back to that old know thyself. What kind of how do you actually handle these situations? But yeah, man, a really, really good chat. Very interesting, and we've got a lot to look forward to this year for sure.
Yeah, most definitely. And there will be aspects of the economy that unfold in 2026 that we did not expect. I don't think anyone could have predicted. Well, there were some people who predicted the run in gold and silver. I don't know if they expected it to be in this fashion, but there will be something else, some other asset class, something else that will just catch the entire world by storm. There will be 1,000 ETFs that drop the week after, trying to capitalize on that attention. And so you can bet on that, is that the world is, and also the younger crowd is also getting more and more interested in getting started earlier. And Robinhood's working on different ways to make that happen. So whether or not you think it's a good or bad thing is coming. The younger people are interested. There's all sorts of educational content being put out for the younger generation to try and figure out what that is. We have, I think it was the Trump accounts or something like that to get people started earlier. So like people are generally trending in that direction. And so I'm not sure what to think. Like there's probably a way wider macro conversation to be had. Because like, up until now, it's always made sense. Like you want to be invested. That's the only way to get ahead. But now we're in this world of like, which ones do you invest in? And there's all this calling into question of like a lot of the investments now. Like, is that even real? Like, are the stocks up or is it the dollar's down? And it introduces like this whole new like conversation, because now you're like, well, it doesn't matter, just get into risk assets. And you're like, well, that means you are forcing everyone to bet on the United States economy. But if it's not real, then you're forcing them to buy into this. So it becomes this whole like conspiracy theory tinfoil hat conversation probably. But I think the conversation is going to come around anyway. And we have them a lot in our conversations here at Wolf. And so I'm sure we'll have all sorts of conversations. Thomas, dude, thank you so much for joining me as well, as always on the show. Definitely, guys, if you enjoy the conversation, especially on the Bitcoin side of things, Bitcoin tracking, the Bitcoin ETF tracking, Thomas tracks a lot of that on his X account. We'll have him tagged right above our faces. You can check out his Apollo, and he has all the inflows and outflows checked out there. Definitely recommend it. And if you enjoyed the show, please definitely give a follow to us over at the ETF Tracker. Big shout out to Rex Shares for sponsoring the show. I'll see you guys all in the next one. Take care.